Good morning, everyone. I am John Wilson, Head of Technical Research and Policy at Spence and Partners. Welcome to this, our latest Horizons webinar on the most recent developments in pensions law and practice. A number of items on the agenda today, but just before I get to that, just a little bit about, I suppose, housekeeping. Everybody is muted on this type of webinar, but that does not mean that you cannot engage with us, and we hope that you do. There is a question and answer box, so please put any questions that you have or any other observations into that, and we will pick up on them during the presentation if we can, and anything that we miss we'll have a look at and cover towards the end. Today's agenda then, as I say, several items. New legislation related to company survival in the wake of the pandemic. Some new reporting requirements, actually aimed at auditors, but a number of things in there that trustees need to be aware of in terms of reporting in 2020, and that would include things like trustee reports, but also chair statements, and I think there's some implications there for annual member benefit statements too. A quick update on the latest guidance from the pensions regulator effective July in terms of easements that are possible following the ending of their existing COVID-19 and pension scheme guidance, which will come to an end at the end of this month. And then a quick mention of the ruling in the judicial review case of Hampshire and its implications for the Pension Protection Fund in terms of compensation that must be paid, and maybe some wider implications too in terms of schemes that are secured outside of the PPF with PPF plus benefits, and a mention too of possible implications of this ruling on the Pension Protection Fund risk-based levy. So starting first then with the Corporate Insolvency and Governance Bill. Now this piece of legislation is not, as some people seem to think, entirely new and just a response to the current pandemic. Some of its provisions were actually consulted on as far back as 2018, but there are some new measures in it, and the timing of implementation of this bill is very, very much COVID-19 related. We expect the bill to become an act by the end of this month and for its measures to come into force as early as next month. I don't want to look at all the measures in detail because I want to focus on some of the implications for pension schemes, in particular defined benefit pension schemes. But just to set the scene, some of the key measures to be aware of are: the bill creates a moratorium during which no legal action can be taken against a company without leave of the court. It allows courts to sanction a plan that binds creditors to a restructuring plan if it is considered fair and equitable and in the interests of all creditors. Creditors voting on the plan, creditors can vote on the plan, and that would include trustees of pension schemes, but the court can impose something even on the dissenting creditors, the so-called cram down provisions. And finally, for the purpose of today's webinar, the bill removes the threat of winding up proceedings where unpaid debt is due to COVID-19 and introduces temporary provisions to void statutory demands issued against companies during the crisis. So these are the measures to keep in mind now as I turn to some of the potential implications for pension schemes, which I should add at this time are not entirely clear. But what I think we do know is that both a moratorium or restructuring plan is not a qualifying insolvency event under pension scheme legislation. So the moratorium or restructuring will not trigger a PPF assessment, nor is it a Section 75 trigger for the purposes of employer deficit or pension scheme debt. Deficit reduction contributions, very topical at the moment, are not payable during the moratorium in terms of the Corporate Insolvency and Governance Bill, but something to be aware of at a scheme provision level is that non-payment of contributions might be a trigger in terms of trust deed and rules. Trustees are unable to obtain a winding up petition for unpaid contributions or enforce charges or guarantees during a moratorium. And whilst it's not explicitly clear how the moratorium and restructuring provisions link with TPR powers, we think in terms of looking at the provisions and some existing cases, such as the quite high profile case of Nortel, there will be implications around TPR activity on notifiable events and the pension regulator's power to issue financial support directions and contribution notices. It's so-called moral hazard powers. The big worry for us, and something that we do not think has yet been addressed, is the possibility of effectively the pension scheme falling between stools. And let me explain what I mean for that. You have a situation where these scheme rescue provisions are utilised. Perhaps a scheme of arrangement is agreed, where there is a new co or new company formed, and the existing company is struck off. And it seems, on the face of the bill at least, that you could have a situation where there has not been a qualifying insolvency event, so a pension scheme cannot be assessed for pension protection fund compensation, and nor is there a statutory employer in terms of ongoing obligations to fund that pension scheme in line with scheme funding provisions. So there seems, at least in theory, that there is a possibility that pension schemes could be cast adrift depending on the operation of the Corporate Insolvency and Governance Bill in practice. And this issue has been highlighted to the Department of Business, Department for Work and Pensions, and indeed the Pension Protection Fund. I mean, the extent to which it would happen in practice, I would imagine, is quite remote, because it is rare for a pension scheme to be separated from the employer. But something for trustees to be aware of, just in terms of this is now a bit of a known unknown, if you like. And for me, I think what it does is reinforce some of the recent messaging from the pensions regulator, most recently in its annual funding statement, that it is absolutely imperative during this time for there to be collaboration between trustees and employers. And even though keeping visibility of a company can be quite difficult at the moment, monitoring employer covenant and being ready for companies who might be stressed or likely to be in distress becomes an even bigger imperative. So Corporate Insolvency and Governance Bill, I think, is going to be a big issue, probably for the second half of this year. And as I say, I do expect it to come into force within a matter of weeks. It is being fast-tracked through Parliament, as we speak. But moving on now to something much more directly pension scheme related and directly related to trustees of pension schemes. Guidance has been issued, and as I mentioned at outset, this was primarily aimed at auditors around expectations on reporting, primarily in financial statements for 2020. But there are a number of things that trustees should be aware of and should take into account in terms of their timescales for preparing things like the trustee report. Some of the key messages that have come out of the guidance are in relation to the trustees report and the chair's statement, which goes alongside financial statements. Trustees should reflect on the impact of COVID-19 from a governance perspective. So to what extent has it impacted in practice on management and oversight of pension schemes? Consideration of going concern in the preparation of pension scheme financial statement requires greater focus due to COVID-19. And we've already been told by auditors that they are expecting specific statements around the crisis to be included in the going concern wording in trustee reports. Accounting for scheme investments might be a bit more challenging during the crisis. So consideration of this, and if necessary, discussion between trustees and auditors should begin early in the process for preparation of accounts. Specifically, for pension schemes with accounting periods ending on 31st December 2019, the COVID-19 pandemic this year is likely to be a non-adjusting event for accounts purposes. For subsequent reporting dates, schemes have to judge themselves how much of the impact of the COVID-19 pandemic should be considered to arise from non-adjusting events. And finally, in undertaking work in relation to the auditor's statement about contributions, the auditor will need to know whether contributions to the scheme have been impacted, and that could include reduction or suspension of deficit reduction contributions or future contributions, changes in pensionable earnings, and the furloughing of employees. So a bit of extra information that needs to go into trustees' report and the chair's statement there in light of the pandemic, maybe a bit of extra time required in terms of the production process, and maybe a bit of thought given to other documents that are used for reporting as well. So, for example, benefit statements, which I will get onto, and the extent to which additional wording should accompany them in light of the effect that the current pandemic has had on members' benefits, maybe more so in DC schemes in the context of the annual member benefit statement. So, the pension regulator has already issued guidance on what easements it is allowing during the pandemic. That original guidance was issued in March and was effective up until the end of this month. And they have very recently, as they promised to do, now issued updated guidance in terms of what is available going forward from July. And perhaps the key message to take away is that requests to suspend or reduce deficit reduction contributions, or indeed future contributions, are still possible, provided that the business case is being made to trustees as to why that reduction or suspension is required. Now, our experience in terms of our own portfolio schemes so far, and I think this is consistent with experience across the marketplaces, only around 1 in 10 schemes have over the past few months sought to defer deficit reduction contributions. But we think it is likely that as we return to some kind of normality and job security schemes come to an end, that there is likely to be an uptake in the number of pension scheme sponsors that are looking for some help with the funding of the pension schemes. So that 10% might be a materially higher the next time we discuss requests for DRCs to be suspended or reduced. The other aspect of the updated guidance is that some of the relaxations on trustees reporting to the pensions regulator will fall away. And the key message is that from 1st of July, pension trustees should resume reporting to the pensions regulator. Areas that reports might need to include will be suspended or reduced contributions. So you can do it, but you need to tell the regulator. Any delays in valuations and recovery plans, and delays in cash equivalent transfer value quotations and payments. Some of the other measures are more related to pension scheme governance and administration. And the regulator has commented on annual benefit statements, where the pensions regulator will continue to take a pragmatic approach, accepting that the impact of the pandemic could mean that schemes need some additional time to issue these to members. And that might certainly be the case if additional information is being included around the impact of this crisis and what effect it has had on pension schemes and member outcomes. On accounts, that is pension scheme accounts, trustees will be asked to report any failure to prepare audited accounts. And maybe on a related note, chair statements. The legislation around chair statements does not allow the regulator discretion in relation to enforcement, but the pension regulator does go on to say that it does not expect to be reviewing chair statements before the autumn. But I think the key message there is that existing timelines remain in force. So the last thing that I wanted to cover on my agenda today is actually the most recent development, and I suppose it is the latest judgment in the ongoing Hampshire case, or Hughes and the Pension Protection Fund. Now this was a case that originally went across to Luxembourg and the European Court of Justice, where the European Court of Justice held very, very broadly that under the Pension Protection Fund, members must get at least 50% of the value of their benefits. Now, there was some uncertainty over exactly what that meant in terms of minimum quantum for Pension Protection Fund compensation. And there was also a separate issue, which has now been decided in terms of the Pension Protection Fund compensation cap on PPF compensation, which is roughly at the moment about £40,000 per year. It is revised each year. And in this latest development, what was decided was that the PPF compensation cap is unlawful and discriminatory on grounds of age and must therefore be disapplied. So this means that the current position is that the PPF should have paid and should still be paying compensation equivalent to 90% of affected members' annual pensions without a cap, which it currently applies or has been applying. It was confirmed that the principle that a member is entitled to receive at least 50% of the value of their actual entitlement and not 50% of an actuarially estimated figure. So this means that the system needs to ensure that calculations can be adjusted if a member is in fact at risk of receiving less than 50%. The one-off initial calculation which has been used is unlawful. And finally, I think in terms of substantive findings, the judge found in the claimant's favour in relation to survivors' benefits, holding that the Pension Protection Fund needs to ensure that compensation of at least 50% of survivors' benefits is paid. There were other arguments in relation to limitation, which the claimants lost, and this particular judgment did not deal with the issue of whether arrears, which might become due for some PPF members, should have interest added. But the upshot of all of this is, of course, that the Pension Protection Fund will need to relook at the PPF compensation that it pays on schemes which transfer to the Pension Protection Fund. There will be implications for schemes that are in a PPF assessment period where trustees still administer the scheme, pending a decision on whether the scheme can transfer to the PPF. There will be implications in terms of schemes which wind up outside the PPF, where they have enough funding to provide benefits in excess of what would happen where the scheme transferred to the Pension Protection Fund. And while there hasn't been any confirmation of this, the PPF and the DWP are still considering the ruling. There could be implications around the PPF risk-based levy, which is payable by defined benefit pension schemes. But let me put that into context. Only a small amount of members are currently affected by the compensation cap. Most members going into the PPF do get 90% of their full benefits without a cap, but there are some members where the cap can be a material part of the potential PPF compensation, and clearly this particular aspect of PPF benefits must now be revisited. And that was my roundup for this latest Horizons webinars in terms of what has been happening over, I suppose, the past few weeks. I know still some uncertainties there, but a number of provisions that trustees need to be aware of. The Corporate Insolvency and Governance Bill absolutely must be on trustee radars. And where there is any concern that a scheme sponsor may avail itself of the company survival provisions in that bill, I think it's absolutely imperative that trustees make sure that they are getting some expert advice around the employer covenant and what potential restructuring implications there could be for a pension scheme, and just where the pension scheme would sit in terms of potential different outcomes, and what right it has to have information. As I say, the bill is nearly an act, and the most recent development is that the implications for pension schemes have been debated, but not a lot of change has been made in light of that. Only the right for the pension regulator and the pension protection fund to get information, and there is a measure being suggested around the PPF actually being able to contest some of the proposals that might be being made around business rescue. The extra reporting for trustees, again, please do keep that in mind. If you're, a lot of scheme ends are end of March or end of tax year, so think about extra narrative and extra time that might be required to cover the current crisis. The COVID-19 guidance from the pensions regulator is still quite useful, and there is a degree of pragmatism there. The pensions regulator is, I think, alive to some of the challenges facing pension schemes at the moment, but note the new reporting requirement if you are using any of the easements. And for the Hampshire ruling, I'm afraid at this stage, it really is an element of watch this space, and the next milestone probably being an announcement from the Pension Protection Fund as to what it is going to be doing going forward, and also correcting benefits that might have been paid in the past, where those benefits have now been ruled unlawful. And really on that note, as we approach 10 o'clock, we'd usually like these webinars just to last around 30 minutes. I am looking at the Q&A box, and as I speak, somebody has actually posted a question. And the question is, so the Pension Protection Fund benefit is greater of 90% uncapped benefits and 50% of scheme benefit, right? So the PPF compensation does actually depend whether or not somebody is in receipt of a pension and past their normal pension age. And for many people, they will get 100% of their scheme benefits uncapped. But there are other members, deferred members, I suppose, being the key category, for whom the benefit is 90% of their scheme benefits, and until very recently, that was subject to a cap of around £40,000 a year. I think for this year it's just above 41,000. So, but my understanding of the ruling is saying that with Hampshire, that yeah, there is that test that you must, in any event, notwithstanding the PPF formula, get at least 50% of the scheme benefit. And as I say, clarification of what that means is that 50% means they must get at least 50% of his or her actual entitlement. There is another element to this as well, in that there are separate proceedings in a case called Bauer, which requires the Pension Protection Fund to also apply a minimum poverty test in terms of making sure that people get PPF compensation, which is at least equal to what is required under the European Union Insolvency Directive, which is the catalyst for all these legal proceedings. So at the moment, it's a bit of a mess, and that I suppose there's various ways that this could now develop. We await the reaction from the Pension Protection Fund. They are discussing with the Department for Work and Pensions. There would be opportunity to make changes to the legislation because there is a pension schemes bill currently before Parliament, which is still going through the various stages. And to what extent it's relevant, I'm not entirely sure, but do remember that the end of this year is the end of the transition period for the UK leaving the European Union. So at that stage, it would, at least in theory, be open to the UK to not fully comply with the 1980 EU Insolvency Directive and to restate the Pension Protection Fund compensation. I suspect that's unlikely, but Brexit, I suppose, is another factor in this, given that the catalyst for the establishment of the PPF in the first place was the European Union. I'm not seeing anything else coming up in terms of the question and answer, so I'll just close by thank you again for listening. The slides, and in fact, I think the webinar will be available after this live event. If anything arises that you think, I should have asked that, then please do get in touch, and I'll be happy to respond on any queries that occur to you after the end of the webinar. But in the meantime, thank you very much for your time. Have a good day. Thank you, and goodbye.